Hi, everyone. It's AJ with North Capital Mortgage, and today we are talking about Fed funds rates and mortgage rates. There has been a lot of talk about what the Fed is doing with interest rates. Are they going to cut rates further? Are rates going to remain the same? And how will that affect mortgage rates? There's a lot of people that are waiting on the sidelines for their mortgage financing to hopefully see interest rates come down. But will that happen? Let's take a look at the relationship between the two and give just a general overview of how they work with one another. Firstly, we want to look at what is the Fed funds rate. So, the Fed funds rate is an overnight interest rate that banks charge each other for short term loans. So, you may be asking, why are banks borrowing from one another? And banks, when they have loans that are outstanding to consumers or businesses, they have to have overnight a certain percentage of that as margin within their accessibility. And if they don't have that, they have to meet those margin requirements by borrowing from other banks overnight. This interest rate is set by the Federal Reserve. Okay. Its purpose is to manage inflation, stabilize employment, and hopefully guide the economy. Uh, when the Fed increases rates, borrowing costs will go up. And when borrowing costs go up, that should signal the economy to generally cool down. And when that happens, the price of goods will generally come down. So inflation should cool down. So a rate increase, again, should generally and hopefully cool inflation. If rates are cut by the Federal Reserve, then borrowing costs fall, and that should hopefully spur the economy. There is a downside to this. Inflation risks may occur, which could cause inflation to go up. So again, rate cuts, economy will hopefully grow, but with the possible side effect of inflation. Okay, uh, what are mortgage rates? Mortgage rates are long term interest rates for home loan financing. And this is not set by any type of independent body such as the Federal Reserve. These are basically set by the market. So the key drivers are going to be the 10-year US Treasury yield, most notably because they generally have the same risk profile as a long term mortgage pool. Inflation expectations are going to also be a key driver in mortgage rates, and also just the demand for mortgage backed securities. If you're selling a pool of mortgage loans at 4%, because that's the average coupon, and you can take your money and invest it elsewhere with the same risk profile for 6%, that's going to certainly drive the interest rates for long term mortgage rates up. Okay. So, again, set by the market, not by an independent third body. What is the connection between the Fed funds rate and mortgage rates? It is indirect. It's not a direct, immediate relationship between the two. Mortgage rates are actually more closely tied to long term treasury yields, as we already mentioned. In the aggregate sense, you will see that mortgage rates and Fed funds rates are tied together and will generally move in the same direction, but there is a lag and there is going to be some variability. Mortgage rates don't always change immediately with the Fed rate. They may have a lag in time due to market expectations, inflation, and investor demand. So let's take a look at a chart here. This is the federal funds rate versus the 30-year fixed mortgage rate. We have a chart overlaying the two, and you can see that since the early 80s, we can see that as the Fed funds rate shifts, mortgage rates are generally going to follow that trend. Okay, so if rates go down, mortgage rates should come down. If Fed funds rates are going up, mortgage rates should trend up. If we look at the past year, 2024, you can see that in a smaller scope, as what happened in Q4 of 2024, Fed funds rates were lowered and mortgage rates actually went from close to 6% all the way up to almost 7%. So that was probably due to the market the market expecting a higher rate cut, and they didn't get it. So rates went up, and this happens periodically. It also just happened last week. The Fed lowered the Fed funds rate by 25 basis points, and mortgage rates went up by about an eighth or a quarter. Okay, so if you are anticipating making a purchase or a refinance and you are waiting for the Fed to lower rates, you can wait, but you should know in the immediate term, those mortgage rates may not follow as you may hope they will. And what I always tell people is if the numbers work then you should not worry about the interest rate. And what I mean by that is, for example, in the early 80s, when interest rates were 12, 13, 14% for mortgages, uh, people probably weren't waiting until mortgage rates came down to 6 or 7 or 8%. And that's what I tell people today. If the numbers work, if based on your personal income and your personal cash flow, regardless of what the interest rate is, if the numbers work for you and they make sense, then you should proceed with that transaction. And ultimately, what happens is if you lock in a 6.5% interest rate today, and this is the floor, and rates go up over time, then you're a hero for acquiring that 6.5% rate. But if they trend down over a period of time, and if Fed funds and mortgage rates do come down, you have the opportunity to refinance in the future. Okay. So don't get too carried away with monitoring interest rates constantly at the finite level. Try to take a more aggregate image of what's happening on and proceed in that manner. So hopefully this makes sense to you. If you have any questions or you would like to further discuss, please give me a call. AJ at North Capital Mortgage. Always happy to help. Hope you have a wonderful day.